Hey, Eric.
Morning, Ed. How you doing?
Good, good. Well, Cooper got to star last in our last webinar, so Max got a little jealous. So he decided that instead of sleeping right from the start, he'll come and wish everybody a Happy New Year. I've been trying to get him to wear this, but he doesn't like the band, but he looks pretty good in it. Remember when we had the solar eclipse? He was wearing the solar glasses, so he uh, he goes with the flow. And I think at this point we'll let him go wherever he wants to flow to, which I suspect is going to be back there taking a nice nap. How have you been, Eric? Okay,
Yeah, all good
good,
here. It's
good.
been a
I
good
hope
year.
you and everybody listening in had a Merry Christmas and are having a Happy Hanukkah, and hope everybody has a great New Year. Eric and I actually aren't here. We're officially on vacation. At least Yardeni Research is on vacation. But Eric and I, in our spare time, just can't avoid thinking and writing about the market. So we've been doing some quick takes on the market. They've been a little bit longer because we're not doing the morning briefings, but the morning briefings will be back January 6th. Everybody else will be back, and so we're looking forward to the new year. And it's hasn't started yet, but it seems to be going in our direction, right, Eric? What's going on with this market today and past couple of days?
Yeah, I mean, we're starting to sell off, I guess, a few days early. Maybe PMs want to take their profits. They had a pretty solid year. You might want to just hedge your exposure a little bit, but choppy waters ahead. I mean, there's a number of things that could go wrong, number of things that might go wrong. Doesn't really like knock us off the bullish path, but definitely some murkier waters, at
Yeah.
least in January.
Well, we made a list of these things in the latest quick take. So let me just list them, and then we can get into them and look at some of the charts. Again, we don't have the morning briefing charts because we're off, but we've got some charts from the quick takes. So, in terms of what could go right, which is, I guess, what we're very well known for, is focusing on what could go right, since so many people spend so much quality time on what could go wrong. But in terms of what could go right, the earnings season looks like it's going to be fine. Analysts haven't really been cutting their estimates that radically. They're down to a growth rate of 8.5% on a year-over-year basis, and there tends to be a upside surprise during economic expansion. So we could see the earnings up 10%. So that'll be fine. What are we thinking about GDP, Eric?
Yeah, it looks like around 3%, with pretty solid consumer spending. So yet another good quarter. Consumers continuing to use those real wage gains and heavy net wealth gains, I suppose, in real estate and stocks to keep spending down.
Yeah, there's got to be a huge wealth effect from what's going on here. So we're still expecting the savings rate to turn negative, partly because the baby boomers are retiring and aren't going to have any income to save out of, and they're going to be dipping into their net worth. But it's not a bad situation for the baby boomers to be retiring and dipping into their net worth and still seeing that there's when they look at their statements, their net worth is up. Uh, the value of their portfolios, the value of their real estate is going up faster than they're dipping into it. Um, what you at all concerned about the Citibank economic surprise index? I know some people are starting to point out and say, "Oh, this is an indication that we got another slowdown going on." Any thoughts on that?
Yeah, no, I mean, it's been pretty bumpy. You get, weak economic data and the expectations for economic data weaken, and then you get a rebound. So it's just kind of been bumpy, but I mean, with real growth at 3%, things look pretty good. It's just kind of like,
Yeah,
running a cyclical pattern. But it's interesting that the bond yield or long-term bond yields have diverged and they're continuing to rise, while the Citigroup surprise index starts to fall. It could be fiscal concerns, waiting to see. I mean, we have the deficit, the debt limit hasn't been raised, so we'll see what happens in January. I know Trump floated, just scrapping the debt limit which is effectively what we do anyway. So we'll see what happens with that. But yeah, I mean, I wouldn't be surprised if in January bond yields came back to earth a bit. Just like portfolio rebalancing could hurt stocks, it could easily help bonds as you rotate to make up for the losses on your bond side of the portfolio.
Yeah, did you notice that Treasury Secretary Janet Yellen is coming up with a January surprise for the administration? And the surprise is that we're going to hit the debt ceiling here around January 14th. At least that's what she says. There's a lot of wiggle room around that kind of calendar date. But
Yeah,
I guess it was last in 2023 that they suspended the debt ceiling. So we've had no debt ceiling uh, per se, but they said that they would reinstitute it actually on Thursday. So on Thursday, the debt ceiling, I guess, is going to be what the debt actually is, which is $36 trillion, which means we're at the debt ceiling as of Thursday. And then the government starts to become concerned about its ability to raise money, additional money. But a lot of that is the political gaming we've seen before. So it's the kabuki play, if you will. So there's certainly some good fundamentals out there on the economy, on earnings. Let me just make a list of things that we're concerned about, at least in the short term, as being troublesome for the market, perhaps. I guess the market, we felt is vulnerable. There are too many bulls. The bull-bear ratio is too high, and a lot of other sentiment indicators suggest there's too much bullishness, which from a contrarian perspective is negative. So let's make the list here. We got portfolio rebalancing. We'll get into the specifics in a second. So portfolio rebalancing, Fed fight, Trump 2.0, bond vigilantes, strike, and geopolitics. And maybe once we go through these, Eric, we'll ask our friends out there to chime in and tell us if we missed anything that could possibly go wrong in January. But I kind of doubt that portfolio rebalancing just started today. It seems like the Boeing crash obviously has had a big negative impact on Boeing, and that's important for the market, and maybe just cause some traders to take some profits. And I guess traders don't, since they day trade, they don't care that much. They don't pay that much attention to taxes. But what about people who do pay attention to capital gains taxes?
yeah. I mean, it was a good year, so might as well sell and take profits early in 2025. So you push those capital gains out. Still don't know what's going to happen in 2025. Hedge funds, households, etc. Like exposure to equities is at or near record highs.
It's at record highs, yeah.
Yeah. So I mean, if you're if you have a ton of stocks, right, like you're going to need to rotate into bonds. If you use TLT, the long-term bond ETF as a proxy, it's down like 5% this year, and then you have stocks up 20 to 30% depending on what you had. So you'll definitely rotate a little bit. And if you're a pension fund, you have to, right? Like you have asset allocation exposures. So we'll see how that goes, but it's just kind of, it doesn't really alter the long-term path. It's just something that happens to markets for a few weeks.
Yeah, I just put this on the screen. Can you see it, Eric?
Yeah, it looks
Yeah,
good.
so this is from the quick takes. I think it's a pretty interesting chart. It shows the percent of net worth and the percent of financial assets that corporate equities, both directly and indirectly held. This is flow of funds data that the Fed puts together on a quarterly basis. And you can see that when you look at households and nonprofit organizations, that's the way they do it. They don't split it out. So when you take the equity allocation percent of financial assets, you're a record high of 43.4% for the for this sector. So they are at a record high. Back here, we had the earnings story, and I mentioned that we're at 8.2%. I should have said on a year-over-year basis, the same as what happened. The actual report for the third quarter. So in the fourth quarter, the analysts are looking for 8.2. You can see that the growth rate expectations has come down, which is very typical of analysts approaching earnings seasons. And then, surprise, surprise, we get some upside surprises. We call these earnings hooks. And so we expect to see another earnings hook that could take it up to 10%. Let's see what else we got. Oh, Eric, why don't you tell us about the Fed fight? I guess what we're talking about is there's a little maybe a growing disagreement among Fed officials about what the neutral interest rate is and whether interest rates are actually restrictive here.
Yeah, you definitely seem to see it or hear it in Fed speeches and commentary, but you can also see it in the summary of economic projections right here. There's a lot of debate of whether the Fed, first of all, should have cut at the last meeting or whether they are at, kind of neutral and they really need to cut much more. Some Fed officials like John Williams in New York and Austin Goolsbee in Chicago think that there's some kind of magical neutral rate of interest, which is far lower than where we currently are. So there are those dots that are kind of at the lower end of the range. And then there's kind of more market oriented Fed officials. So Beth Hammack, who just came from Goldman Sachs, was one of the dissenters, or the only on paper dissenter at the last meeting, who favored just pausing. And, I think the kind of evidence or the economic evidence is that, inflation is kind of sticky, growth is really strong. Why not just hold off right here and see how things, things continue? But yeah, it's there's a lot more dissent. We see that there are 4 dots, so 4 total people on the FOMC would have liked to have paused last meeting rather than cut.
Hey, let's move on. So that's the Fed fight, and that could rattle the market if we start to have some of these officials saying we have to keep lowering rates, and other officials saying no, we don't. Let's go to Trump 2.0, and I guess the issue there is, the bond vigilantes may not be, ready to sign on to the idea that the Doge boys, as we call them, and are going to be able to cut the deficit all that much. I think when he was asked about how much he expected to cut out of the deficit, Elon Musk kind of blurted out at one of the big conferences that he thought they could take $2 trillion out. He never really mentioned over what period of time, but there's just no way you can take. Let me see if I had it here. Yeah, no, I have it in the other one. I'll bring that one back. But this is the amount of debt outstanding, and that's an issue for the bond vigilantes, and they're certainly acting up. They're a little bit simmering down today, perhaps, but we're still at 4.55. We're still almost up 100 basis points relative to when the Fed started cutting the Fed funds rate by 100 basis points. So the bond vigilantes have been tightening as the Fed has been easing. So the bond vigilantes are doing what they're supposed to be doing. They're trying to be vigilant about reckless fiscal and monetary policies. And it's been our view that by cutting 100 basis points, the Fed has been a little bit on the reckless side because they didn't know who was going to actually win the presidential election. They still don't know exactly what fiscal policy is going to look like, but probably easier for the Republicans to get tax cuts through than to get spending cuts through. So there's a lot of give and take. And then with regards to overall Trump 2.0, a lot of moving parts here: tariffs, the deportations, regulations, energy policies, just a whole mix of different policies that could have unintended consequences. The bond vigilantes, well, we mentioned Yellen, so we don't have to go there. Eric, give us a sentence or two on the strike.
Yeah, so we all kind of talked about the longshoremen for a little bit there and then kind of cast it aside. But the thing is they agreed on wages, but there's still a big issue with automation. Naturally, the union wants less automation to protect labor and their jobs. So that's a discussion coming up in just a couple of weeks. Trump has publicly said, he supports the longshoremen, doesn't want them to lose jobs to automation. It's very likely that people in his administration understand that productivity comes from this kind of creative destruction. So we'll see what happens. But any kind of strike there could either raise prices or just disrupt, trade and be just an overall net negative. But we'll see what happens.
Yep, we'll see. Just another, while we're making a list of what can go wrong, that should be on there clearly. This is the previous quick takes, the one that we did on Saturday, and this is the bond vigilante one. So I know some of you aren't used to us looking for what could go wrong, but occasionally we think it's important to do so. And again, we often find that the bears do a great job of covering all this, but it seems like they're maybe they're on vacation. But look, this is this chart thing, which is pretty neat, showing the Fed funds rate being dropped by 100 basis points. This is the bond yield going up by 100 basis points. Even the two-year yield is going up, and the two-year yield is a pretty good indicator of where the market thinks the Fed funds rate is going to be in a year or so. So that's been quite a change of perceptions of what interest rates are going to be doing. This is the bond yield using some of our amazingly sophisticated technical tools. Just draw a line down here, a line up there, and you can see we've kind of broken out to the upside here on the bond charts and the yield chart. This is the TLT chart. And looks like, we could still get up to 4.75%, and wouldn't rule out something like 5%, at least on a real short-term basis, as the bond vigilantes trying to convey to Washington that they're not happy with the mix of fiscal and monetary policies. This is what Eric mentioned before, that it tends to be not a great correlation, but some correlation between the CESI and the bond yield. And so when they diverge like this, the bond yield's going up and the CESI is going down. As Eric mentioned, this does suggest that maybe they are concerned about fiscal excesses, and that's why some signs of a slowing down in this indicator anyways aren't bringing the bond yields down. We also look at bonds on a global basis, and we point out that bond yields have been going up in the U.S. since mid-September, but they recently started to go up in other places. So again, maybe in Germany and France, there's concerns about the lack of a government, which is something to be concerned about, and as a result, a concern about fiscal discipline. Meanwhile, Eric, Reuters reported, and I haven't seen anybody else confirm it, but Reuters last week, and we wrote a quick takes about it. Reuters said that the Chinese government has this big fiscal spending program that they're cooking up, and so far the bond market doesn't seem to acknowledge that. It's down to 1.71%. It hasn't really picked up. Maybe there's, I don't know. You any thoughts on that, Eric? Why we're not seeing a response?
Yeah, I think you need to actually see the tangible. Like, there's been so many words. You need to see something tangible actually happen. But I think in terms of Chinese government bond yields, there's still kind of a lack of supply, right? Like, a lot of the fiscal stimulus and debt financing in China happens at the local government level. It doesn't happen at like the federal, like our treasury issuing debt. So there's probably fiscal room for the central, the CCP to centrally issue debt and stimulate the economy. Their debt to GDP is pretty low when you just think about central debt. So maybe they need to do that, because the stock market is pretty bad there. The property market's completely collapsed. If you're a saver, you might be plowing into government bonds right now. So the demand is just outweighing the supply. But you probably just need to see some more real bazooka-like stimulus for that to get some lift.
Yeah, I think we're kind of scratching our heads and wondering why the Chinese government doesn't do what the Trump and Biden government did during COVID, and that is just deposit checks, helicopter money. It worked like magic here. Maybe they're concerned that the Chinese consumer won't spend it, but will save it, and that would be a total embarrassment. I mean, that would say that they've got no tools to really revive their economy. But it's a head scratcher, because I think it's the most obvious thing to do. And instead, they're talking about some attempts to stimulate the consumer with, if you bring it, remember the cash for clunkers programs we had here occasionally. It's not quite that, but you can you can sell your car or appliances and get a discount and a new one. And this is just back to the Doge boys showing the total government spending is over $6 trillion, and over $5 trillion is non-discretionary. So this is what they have to play with, and that's basically a trillion. So there's no way you can cut $2 trillion out of only a trillion of discretionary. So at some point they may have to change their language and goals to say it's 2 trillion over 10 years, which sounds pretty pathetic. But then again, if we just get on some sort of sustainable fiscal course that the bond market can live with, that would be a good thing. And this, of course, is the ugliest chart of them all. This just shows what interest expense, the interest outlays of the federal government are doing. And by the way, let's not forget this is called net interest outlays, and outlays are generally stimulative, and the baby boomers absolutely love this. And anybody that doesn't want to take risk and is in a money market fund absolutely loves the fact that they're still getting a fairly decent return with no risk for their money. Eric, just one last thing here, geopolitics, and then let's open it up to the audience. We have a nice turnout again. Let me flash our faces here again. Um, so geopolitics, I think we kind of discussed one issue here, and that's China and its inability to revive its economy. So we beat that one pretty good. The Middle East is it's a horror story, but on the other hand, if you look at it just geopolitically and militarily, it seems as though Israel has managed to really almost completely change the game in the Middle East, at least for Iran. Suddenly, Iran always counted on more on Hezbollah than Hamas. Hezbollah was equipped with, thousands of missiles, and so the Israelis always had to be circumspect about going straight for Iran because Lebanon's right across the border there, and suddenly, if Israel got too aggressive directly with Iran, the Iranians could have their proxies, the Hezbollah proxy, just rain down all these missiles that could overwhelm the defense systems of Israel. So the Israelis, as we all know by now, blew up the pagers of Hezbollah and then decapitated the organization. And by the way, they apparently knew also where all the missiles were. And so there really hasn't been a barrage of missiles coming out of Lebanon. And then they've been working on Yemen. And now apparently there was some amazingly powerful bomb that was dropped in Syria over some of the military facilities. And the internet is abuzz with what kind of bomb it is. But I bet you the mullahs are abuzz wondering what kind of bomb it is as well. But apparently, from all the buzz about what the Israelis managed to do in Iran when they went in there, apparently they did take out a lot of the defense systems. So things could get hotter in the Middle East here in January or February once President Trump is in. And it doesn't necessarily have to be a bad thing. The market might react positively if Iran turns out is completely defanged, ideally decapitated in terms of at least the people revolting there. But it's not that easy to change governments in Iran because apparently the city folks tend to be pretty westernized, but the folks in the country tend to be much more religious and much more pro the mullahs. So it's not going to be over for a while, and if ever, since the biblical times, the Middle East has been crazy, but the price of oil hasn't budged, so that's an important issue. Ukraine, Russia, hopefully that gets resolved in a way that settles it for a while, anyways. Any other geopolitical hot spots you can think of, Eric? I think that covers it, right?
Yeah.
Why don't you field some of the questions that we have here, and we got about 5-6 minutes to whip through them.
So Rich asks, is Besant's Treasury Department going to put a weaker dollar on top of their agenda? I think we can just talk about FX broadly too, and how we're thinking about the dollar.
Yeah, what do you think?
I mean, I think the first thing on his agenda is going to be the debt limit, but no, I mean, the weaker dollar idea probably has to be negotiated through like a Plaza Accord, Mar-a-Lago Accord type deal. Ostensibly, tariffs and some of those policies are going to be stronger dollars. So there's probably a number of things to work through before we get there, but I'm sure they'll talk about it.
Yeah, I just don't see that they're going to come up with a unilateral policy that somehow weakens the dollar. The only way to do that is to get rid of Powell and put somebody in there that'll lower rates by another 100 basis points. That would certainly weaken the dollar, but that's not going to happen. Why don't you take Gus's question, Eric? That's a good one for you.
So where do we currently stand with quantitative tightening and the impact moving forward? Yeah, so it's a little bit in the news or topical as the reverse repo facility, where money market funds park cash at the Fed, kind of dwindles down. It reached $2.5 trillion in 2022, and now it's down to about 100 billion and change. So as that hits zero, the idea is that quantitative tightening should start to drain bank reserves and have an adverse impact on markets. I think the Fed is pretty attentive to this. They're already making moves. At the December meeting, they lowered the reverse repo rate to help keep repo rates lower and prevent any financial crises that arise from repo rate pressure. But I think they'll end it in the back half of the year as reserves start to drain. They don't want any market mishaps, but it's not. I think it's a non-story because the Fed is much more likely to end quantitative tightening early than to let it run and let it have some adverse impacts on the market.
Why don't you read Chip's question and then we'll end with Lee's observation on the longshoremen.
Yeah. So from Chip, with the reopening of nuclear facilities, there are growing apprehensions regarding the risks of energy consumption. Is this an area of concern for us?
Not really. I mean, we think, the high-tech industry, Silicon Valley, for a while that, tends to be more left than right in the political spectrum, tend to be a little bit more woke when woke was in fashion, and certainly had lots of concerns about climate change. Now, their priority seems to be getting back to business, and their business is now promoting, hyping up, developing artificial intelligence, which requires a tremendous amount of energy. And so now their lobbyists are pushing for small nuclear facilities. So we think, when a problem is recognized, the market often solves it, especially when it comes to technological issues. So no, we're not really that concerned about running out of energy or that this will be a major problem. We see it as an opportunity. Technology solves problems. Problem is there isn't enough energy to power all these data centers, but there will be. Why don't you finish off, Eric, just by telling us Lee's interesting observation on the potential strike at the docks?
Yeah, so Lee says the ILA, the union, and New York shippers will arrive at the same resolution they did back in the 60s when containers were the quote unquote automation. They agreed to employ just as many workers that needed to unload a ship, even though cranes were really lifting the containers off of ships and back onto them. So, yeah, I mean, I think when the longshoreman thing was happening a few months back, we were all kind of realizing that a lot of longshoremen are paid upwards of for like six-figure salaries, basically, to just sit at home, once they were done working. Maybe that, happens again. They're a relatively small part of the overall population, but, I guess that's what'll happen. And then maybe we'll see some higher prices at the
Okay,
port.
well, let's wish everybody a happy New Year's. This is Max is going to be wearing this during the new year. Max is becoming a celebrity. I was on a couple of times on CNBC, and he appeared on, and I should have mentioned it. I think next time if he's on and they don't mention it, they did. He was clearly visible, and Sarah Eisen didn't mention it, and I think one of the other anchors didn't mention it. So we'll promote Max because he does a really great job of sleeping during our calls. He finds it very soothing. I hope you find it soothing, but I hope that it doesn't put you to sleep. Again, Happy New Year's, everybody. We look forward to working with you in the new year. Thanks, Eric. Look forward to working with you as well.
Happy New Year, everyone.
Bye bye.